Most traders think RSI is just an overbought and oversold indicator. In reality, that's only a small part of what RSI can actually do. This indicator is called the Relative Strength Index, or RSI. If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you. RSI is an indicator that beginners often use. However, experienced traders or traders who have been in the market for a while often overlook it because they believe it generates too many false signals. I used to be one of those traders. I switched to using other momentum indicators, such as stochastic or MACD. Today, I'd like to bring everyone back to RSI and show you 7 different ways to use it. I hope beginners will enjoy it, and I hope experienced traders won't get bored before we finish. Let's go through all 7 techniques together. Before we begin, let me quickly review RSI in just 2 slides. RSI is a momentum indicator that measures the strength of price movement. The indicator ranges from 0, which represents very weak momentum, to 100, which represents very strong momentum. When you open a chart, you'll see the RSI at the bottom. I've highlighted it in yellow. There is a horizontal line that separates weak momentum from strong momentum. That line is the 50 level. Now, let's divide the chart into 2 sides. On the left side, you'll notice that the RSI stays below 50 most of the time. If you look at the price, you'll see that the market is in a downtrend. In other words, the market is weak. On the right side, you'll notice that the RSI stays above 50 most of the time. If you look at the price, you'll see that the market is in an uptrend. In other words, the market is strong. Now let's add 2 more levels. The upper line is RSI 70. The lower line is RSI 30. The area above 70 is called the overbought zone, or OB. The area below 30 is called the oversold zone, or OS. When the RSI moves above 70, it tells us that the market has become too strong. There has been too much buying. The price has become expensive, so traders may start taking profits. On the other hand, when the RSI falls below 30, it tells us that the market has become too weak. The price has fallen too much and has become cheap. When the RSI enters the oversold zone, like in this example, it tells us that there has already been excessive selling. The price has become cheap. When the price becomes cheap, buyers may step in. As a result, the market may reverse from a downtrend into an uptrend. On the other hand, when the RSI enters the overbought zone, like in this example, it tells us that buyers have pushed the price too high. The price has become expensive. When the price becomes expensive, traders may start taking profits. That's the basic foundation of how to use RSI. From this point on, I'll show you 7 different RSI techniques. Let's begin with the first technique. Technique Has-Hone is the most common one that everyone is familiar with, overbought and oversold. The overbought and oversold zones simply refer to periods when the RSI is either too high or too low. For example, in this area, the RSI falls below 30. This means the market has become oversold. As a result, the price has a chance to reverse from a downtrend into an uptrend. This is where we look for a buying opportunity. On the other hand, when the RSI continues rising until it reaches the overbought zone, like in this example, it tells us that the price has become very expensive. There is a chance that traders will start taking profits. Therefore, when the RSI reaches the overbought zone, we can look for a selling opportunity. If we buy here and sell here, we can make a decent profit. For me, however, I don't buy or sell as soon as the RSI enters one of these zones. I prefer to wait. I wait until the RSI comes back out of the zone. Take a look at the highlighted area. This is the oversold zone. At first, the RSI keeps falling until it enters the oversold zone. At this point, I still don't buy. The reason is simple. The RSI, or momentum, is still moving downward. If momentum is still falling, the price is likely to continue falling as well. So we wait. We wait until the RSI climbs back out of the oversold zone. Once the RSI moves back above 30, it tells us that the market is no longer as weak as before. Momentum is beginning to strengthen. At that point, we can enter a buy trade. The price then has a chance to continue moving higher. The same idea applies to the overbought zone. When the RSI enters the overbought zone, we don't open a short position immediately. We wait until the RSI drops back out of the overbought zone first. Once it falls below 70, it tells us that momentum is no longer as strong as before. The market is beginning to weaken. At that point, we can open a short position or close our long position. The price then has a chance to continue moving lower. Next is technique #2, which is regular divergence. There are actually two types of divergence: regular divergence and hidden divergence. This technique focuses on regular divergence. Regular divergence occurs when the price moves in the opposite direction of momentum. It signals that the market has a chance to reverse. There are two patterns. The first pattern is when the price moves higher while the momentum, or RSI, moves lower. In this case, momentum leads the price. This suggests that the price is likely to follow the momentum and move lower later. This is called bearish divergence. The second pattern is the opposite. The price moves lower while the momentum moves higher. Again, momentum leads the price. Once the momentum turns higher, the price has a chance to reverse from a downtrend into an uptrend. This is called bullish divergence. Now let's look at a real example. In this example, you'll see that the price keeps moving lower. As the price continues to fall, we look for a point where the RSI moves in the opposite direction. It's right here. Notice that the price makes a low, then pulls back, and later makes a new lower low. Now look at the RSI. At first, the RSI is lower, but when the price makes a new low, the RSI is actually higher than before. The price is moving down while the RSI is moving up. That completes the conditions for a bullish divergence. However, I'd like to add one more condition. For me, the first RSI low should be inside the oversold zone. This tells us that the market has already experienced heavy selling and is very weak. Then, as the RSI rises, it should be strong enough to break back above the oversold zone. This tells us that momentum is recovering. Only then do I consider taking the trade. In this case, momentum leads the price. The RSI turns higher first, and after a while, the price follows. This is what we call a bullish divergence. Even when we get a reversal signal, we still don't buy immediately. We need price action for confirmation. For example, we can draw a trend line. As long as the market is still in a downtrend, we wait. Once the price breaks above the trend line, it tells us that the downtrend may be reversing into an uptrend. At that point, we can prepare to buy. Another confirmation is to wait for the price to break the most recent high. Once the price makes a new high, we can enter a buy trade. In this example, the price breaks the trend line and also makes a new high. We can enter the trade at the close of that candle. After that, the price has the opportunity to continue moving higher. Now, let's look at another example. This time, it's the opposite. At first, the price keeps moving higher. As the price rises, we look for a point where the RSI moves lower. Right here, the price makes a high, pulls back, and then creates a higher high. Now look at the RSI at the same points. The RSI is weaker than before. Previously, momentum was stronger. Now it has weakened. The price is moving higher while the RSI is moving lower. My rule is the same. The first RSI high should be inside the overbought zone. Then, as the RSI weakens, it should move back below the overbought zone. This tells us that momentum is weakening. Once this pattern is complete, we can prepare to open a short position. This is called a bearish divergence. Just like before, we don't open the trade immediately. We wait for price action confirmation. We can draw a trend line. Once the price breaks below the trend line, it has a chance to continue moving lower. Another confirmation is to wait for the price to make a new low. Once the price breaks below the previous low, we can open a short position. If you look at the chart pattern, you'll notice that it looks very similar to a double top. When the price breaks below the neckline, we can also open a short position. In this example, we have multiple confirmations. We can comfortably enter the short trade. After that, the price has the opportunity to continue moving lower. Now let's move on to technique #3, which is hidden divergence. Just like regular divergence, the price and momentum move in opposite directions. The difference is that hidden divergence is a continuation signal, not a reversal signal. Let's look at an example. The market is in an uptrend. Focus on this point. This is a low. Notice that this low is higher than the previous one. In other words, the price makes a higher low. Whenever the price makes a higher low, we expect the uptrend to continue. Now look at the momentum. The RSI doesn't make a higher low. Instead, it makes a lower low. The RSI is weaker than before, but the price is performing better. That's the idea behind hidden divergence. Even on a day when momentum is weaker, the price can still make a higher low. So imagine what could happen when momentum becomes strong again. The price has an even greater chance of continuing higher. And that's exactly what happens. The price continues moving up. This is called hidden bullish divergence, which signals trend continuation. Now let's look at the opposite example. The market is in a downtrend. Mark these 2 points. The price makes a lower high. Whenever the price makes a lower high, we expect the downtrend to continue. Now look at the RSI. It seems a little contradictory because the RSI is actually higher than before. Momentum is stronger than before, but the price performs worse. This is how I like to remember it. Even on a day when momentum is stronger, the price still performs poorly. So what will happen when momentum becomes weak again? The price has an even greater chance of continuing lower. And that's exactly what happens. As the RSI weakens again, the price continues moving lower. This is called hidden bearish divergence. I've already explained these first 3 techniques in detail in my previous RSI series. The first video covers the basic RSI. The second video explains regular divergence. The third video focuses on hidden divergence. If you'd like a more detailed explanation, you can always go back and watch those 3 videos. Now let's move on to techniques 4 through 7. These are methods of using RSI that you may not have seen before. Let's take a look at them. Technique #4 is what I call pullback to 5-0. The idea is simple. Instead of focusing on the overbought and oversold zones, we focus on the 50 level. First, let's highlight the RSI 50 line. This line is the key to the entire strategy. Here's how it works. In this example, the market is in an uptrend. If you look at the RSI, you'll notice that it stays above 50 for most of the trend. As the trend continues, the price occasionally makes a small pullback. Whenever that happens, the RSI pulls back toward the 50 line. Notice how many times the RSI touches the 50 line but never breaks below it. It touches the line, then it bounces. It touches it again, then it bounces again. We use these pullbacks to look for buying opportunities. When the RSI pulls back to 50 but doesn't break below it, it tells us that the market is still strong. The bullish momentum is still there. The price has a good chance of continuing higher. Let's look at an example. The market is in an uptrend. As the price continues moving higher, the RSI stays above the 50 level. Eventually, the price begins to pull back. At the same time, the RSI also pulls back toward 50. Notice that the RSI touches the 50 level but never closes below it. This tells us that the market is still strong. The uptrend is still intact. At this point, we look for a buying opportunity. However, we don't enter the trade immediately. Just like the previous techniques, we still wait for price action confirmation. For example, we can wait for a bullish candlestick pattern, or we can wait for the price to break above the previous high. Once the confirmation appears, we can enter a buy trade. After that, the price continues moving higher. Now let's look at a downtrend. The concept is exactly the opposite. As the market moves lower, the RSI stays below the 50 level. When the price makes a pullback, the RSI also rallies toward 50. Again, notice that the RSI touches the 50 level but never closes above it. This tells us that bearish momentum is still strong. The downtrend is still intact. At this point, we look for a selling opportunity. Once again, we wait for price action confirmation. We can wait for a bearish candlestick pattern, or we can wait for the price to break below the previous low. Once we get confirmation, we can enter a short position. After that, the price continues moving lower. The key idea behind this technique is very simple. Instead of buying when the RSI reaches the oversold zone, or selling when it reaches the overbought zone, we trade in the direction of the trend. We simply wait for the RSI to pull back to the 50 level. As long as the RSI holds above 50 in an uptrend or below 50 in a downtrend, the trend still has a good chance of continuing. This technique works especially well in strong trending markets. Now let's move on to technique #5. Now let's move on to technique hash 5, which is RSI trend line. Most traders draw trend lines directly on the price chart. However, you can also draw trend lines on the RSI. In many cases, the RSI trend line breaks before the price trend line. This gives us an earlier signal that momentum is changing. Let's look at an example. The market is in an uptrend. As the trend continues, the RSI forms a series of higher lows. We can connect these lows to draw a trend line on the RSI. As long as the RSI remains above the trend line, momentum is still strong. Eventually, the RSI breaks below the trend line. This tells us that bullish momentum is beginning to weaken. However, we still don't enter a trade immediately. We wait for confirmation from the price. For example, we can wait for the price to break below its own trend line, or we can wait for the price to break below the previous low. Once we get confirmation, we can prepare to open a short position. Now let's look at the opposite example. The market is in a downtrend. This time, we connect the lower highs on the RSI to form a trend line. As long as the RSI stays below the trend line, bearish momentum remains strong. Eventually, the RSI breaks above the trend line. This tells us that bearish momentum is weakening. Again, we wait for confirmation from the price. We can wait for the price to break above its trend line, or we can wait for the price to break above the previous high. Once the confirmation appears, we can prepare to open a buy trade. The important point is that the RSI trend line often breaks before the price trend line. Because of that, it can give us an earlier warning that momentum is changing. Of course, we should never rely on the RSI trend line alone. We should always combine it with price action before making a trading decision. Now let's move on to technique hash 6, which I call trend line break. The trend line here is not drawn on the price chart. Instead, it's drawn on the RSI. Before we begin, I'd like to point out that this technique is mainly used as an exit strategy. It helps us determine when to exit a trade. Let's start with an uptrend. Suppose you've already entered a buy trade. Now you're looking for the right time to take profits. The first step is to draw a trend line on the RSI. At first, the RSI is relatively weak. Over time, it becomes stronger and continues making higher lows. As long as the RSI respects the trend line, bullish momentum remains intact. Eventually, the RSI breaks below the trend line. This tells us that the momentum that was previously strong is now beginning to weaken. If you look at the price chart, you'll notice that the price also starts to consolidate. This suggests that the trend may be losing strength. At this point, we can close the trade and take profits. Let's look at another example on the same chart. Suppose we've entered another buy trade after the pullback. Once again, we draw a trend line on the RSI. The pattern is very similar. The RSI continues making higher lows as momentum strengthens. Eventually, the RSI breaks below the trend line. When that happens, we look back at the price. The price is no longer moving higher aggressively. Instead, it begins rising more slowly. This is another signal that momentum is fading. We can use this opportunity to exit the trade. The concept behind this technique is simple. Momentum leads price. When momentum starts weakening, the price often follows shortly afterward. Exiting at this point is an effective way to protect our profits. Now, let's look at a downtrend. Suppose you've already opened a short position and you're looking for an exit. Once again, draw a trend line on the RSI. The RSI continues moving lower as bearish momentum remains strong. Eventually, the RSI breaks above the trend line. This tells us that bearish momentum is beginning to weaken. At this point, we can close the short position. Doing so allows us to lock in a significant portion of the profit. Let's look at one final example. The market has been in a strong downtrend for a long time. Assume we've been holding a short position throughout the trend. We continue monitoring the RSI. It starts in the overbought area and gradually moves lower. Eventually, the RSI breaks above the trend line. This tells us that momentum is becoming stronger again. When momentum begins strengthening, the market has a higher chance of reversing from a downtrend into an uptrend. This is our signal to exit the short position. By closing the trade here, we can protect a large amount of the profit we've already made. Now let's move on to the final technique. The last technique is actually a feature that's already built into the RSI indicator on TradingView. I call it moving average crossover. Let's see how it works. The yellow line you see here is the default RSI 14. The blue line is the moving average of the RSI. Once again, this is not a moving average on the price chart. It's a moving average applied directly to the RSI. The concept is exactly the same as a normal moving average crossover. When the RSI crosses above its moving average, it signals that momentum is becoming stronger. When the RSI crosses below its moving average, it signals that momentum is becoming weaker. Let's look at an example. At first, the RSI stays below the moving average. This tells us that momentum is still weak. After a while, the RSI crosses above the moving average. This is our first signal that momentum is strengthening. However, just like every technique we've discussed, we still don't enter the trade immediately. We wait for price action confirmation. For example, we can wait for the price to break the previous high, or wait for another bullish confirmation pattern. Once the confirmation appears, we can enter a buy trade. After that, the price has the opportunity to continue moving higher. Now let's look at the opposite example. At first, the RSI stays above the moving average. This tells us that momentum is still strong. Eventually, the RSI crosses below the moving average. This tells us that momentum is beginning to weaken. Again, we don't enter a short position immediately. We wait for price action confirmation. For example, we can wait for the price to break the previous low, or wait for another bearish confirmation pattern. Once the confirmation appears, we can open a short position. After that, the price has the opportunity to continue moving lower. As you can see, this technique is very simple. It uses the moving average crossover on the RSI instead of on the price chart. Combined with price action, it can become another useful confirmation tool. Those are the 7 RSI techniques that I wanted to share with you today. You don't have to use all 7 techniques at the same time. Choose the one that best matches your trading style and practice it consistently. The goal is not to find the perfect indicator. The goal is to understand how momentum behaves and use it together with price action to improve your trading decisions. That's all for today's video. I'll see you again in the next video. If you have any trading topics you'd like to discuss, just press 2 inches. Comment, I'll clear things up for you.